Hello, and welcome to part 2 to chapter 3. And in this part, we're going to be talking about the federal income tax system for both individuals and corporate taxes. Now, up until 2017, both individual and corporate taxes had progressive tax structure. So for example, let me just scoot this over. This is the 2017 corporate tax rates. So any income a corporation made between 0 and 50,000 was taxed at 15%. If any income they made between 50 and 75,000 was taxed at 25%. So the average of the 50,000 at 15% and the extra 25,000 at 25% was an average tax bracket of 18.3%. So as the income goes up for a corporation, the rate of tax increases up until 335,000. Then it goes back down to 34%, up to 35%, then up to 38%, and anything over 18 million was capped at 35%. So this is the progressive rate for corporations. Now, in 2018, a new law was passed, and those tax rates were switched to a flat tax, and the flat tax for corporations are now I believe 21%. Just jumping over to Investopedia and double checking that the federal corporate tax rate is 21%. It's right here, 21%. And that's the new Tax Cuts and Jobs Act that basically created a flat tax for the corporate tax rate. It also changed the corporate tax deductions were adjusted. So the corporate rate has changed significantly since that new tax ruling that you should be aware of. Hold on a second. Okay. Now, corporations, so for many of the problems in this textbook, they may refer to the 2017 progressive rates for corporate tax, which begin at 15% and rise to 35%, as we saw on the chart earlier. After 18.33 million, they'll pay a marginal tax rate up to 38%, and over the 18 million, it's back down to 35%, as we saw before. Now, also, individuals and corporations are subject to state tax. And for some individuals and some corporations, they may be subject to state, federal, and city taxes. For example, New York City has a tax on income as well. Okay. Now let's moving forward. So the individual rates, if we look at the individual rates of tax, there's two different, we have the 2017 rates of tax. And for this textbook, the 2017 rates of tax is what they'd be referring to when they talk about individual tax rates. But I don't believe that you will be, you can find these, I'm just in the textbook, you can find these, let me zoom in a little bit more. Yeah, here's the individual tax rates of 2017. They go from, it depends on your status. If you're single, you have one set of progressive tax rates, and if you're married, you filing jointly, you have another set of progressive tax rates. And there's actually other sets of tax rates, but these are the two most common, single and married. And you'll see that the married income, the income ranges are different, even though the progressive tax structure from 10 to 39.6% are the same. The income brackets are different from married versus single, what you're paying. But now what has happened in 2018 is going to the IRS, the IRS.com, the individual tax brackets for 2017. The brackets themselves have changed slightly for single and married. So there's single, married filing jointly, married filing separately, head of household. That's the same in 2017 or 2018. But what has changed is the tax rates. So if we look, maybe I can get kind of a little bit of both of these in here. If we look at I could fit these here. Okay, so if we look at, let's see, still, okay. So we see that the tax brackets have changed just a little bit, a few $100s, but we go from 10, 15, 25%, but now it's 10, 12, 22, 24, 32. So instead of going 10, 15, 25, 28, 33, 35, we go 10, 12, 22, 24, 32, 35, 37. So the top tax rate has been lowered from 39.6 to 37. So you can see that there's a difference between 2017 and 2018 individual tax rates. So keep that in mind. And when we're doing any problems or work based out of the textbook, we'll be working with the 2017 individual tax rates and the 2017 corporate tax rates. But I just want you to be aware that they have changed moving forward to 2018. So certainly corporate tax is a lot more simple. We just do a flat tax of 21%, and individual taxes are just as complicated as ever. And there was a promise of eliminating the ATM, alternate minimum tax, for individuals, but that was scrapped and it just was modified. Okay. And individuals also have to pay state and local taxes, city taxes. So if you look at an average taxpayer, they'll pay federal tax, they'll pay state tax, they'll pay property tax, they'll pay FICA tax, they'll pay Medicare tax. By the time everything's all said and done, you're well over 50% of your income going to some sort of tax. And certainly if you include sales tax, now you're at the European level of around 60%. So it's interesting that we're paying 60% tax, so is Denmark, but Denmark gets free tuition for their citizens, free health care, and a whole host of benefits. If you have a child in Denmark, you get 3 years paid leave from work and a stipend for the child. So, you know, even though we pay our taxes, I feel, are just as high as some European countries, we really don't get all the benefits they do. And if you look at current politics, they'll say part of that reason is because we're funding such an expensive military that takes a huge amount of our tax revenues. But we also have a huge national debt, which we have to pay a lot of interest on that debt that takes a lot of our tax revenues as well. So that's a couple of reasons why taxes are so high. Now, if we look, taxes do change depending on the source of funds. So if interest is paid, it's tax deductible for corporations. So if you're a corporation and you pay interest on say, bonds that you have, that is tax deductible. But if you're an individual, interest you pay is generally not tax deductible. So if you pay interest on your credit cards, so you have credit card balance, and you pay interest on those credit cards or an auto loan, not tax deductible. Although in some cases, interest on home loans is an exception. Now, earned interest or interest earned is usually fully taxable, except if it's some sort of municipal or government bond. So if you earn interest in a bank account or a bond, you're going to pay federal and state tax on that. However, if it's a federal treasury, you'll be exempt from state taxes. And if it's a state municipal, you'll be exempt most likely from state taxes and federal taxes. But they pay lower interest rates to take into effect the tax status that they have. So if you're a corporation and you pay dividends, dividends are paid after tax. So after you pay your taxes, then you pay your dividends to shareholders. So dividends are not tax deductible for corporations. Now, what about receiving dividends? So most investors will pay, if you're a regular investor, individual investor, you pay 15% tax on qualifying dividends. So investors in the 10 or 15% tax bracket will pay 0% on qualified dividends. So if your earned income is very low, you won't pay any money on qualified dividends. But if you're a taxpayer in the 39% tax bracket, you're going to pay 20% on dividends that a stock would pay. Now, dividends are paid out of net, for a company, they pay the dividends out of net income, which has already been taxed at the corporate level. So this is sort of a double taxation. So the corporation makes a profit, then pays a dividend. The dividend is then taxed at the individual level. So that's a double taxation, a disadvantage of a corporation. Now, what if a corporation receives dividends? Well, if a corporation receives dividends, in order to avoid a triple taxation situation, which would be the company pays tax on the income, and then they pay dividends, and then if a company buys a stock or owns stock and receives those dividends, they're going to have to pay tax on those dividends as income, and then if they pass them on to their shareholders, it'd be taxed a third time. So one way they avoid that is they have a deduction on those corporate taxes. So for a corporation, you're only going to pay tax on 30% of the dividend income received, which is a nice little perk for corporations when they are receiving a dividend. They only pay tax on 30%, and 70% of the dividend received is excluded from a taxable income. So that's a little perk for a corporation, and trying to avoid that triple taxation. So let's just talk about a few more things about taxes. Now, there is what we call a marginal rate of tax. This is the tax you'd pay on the next new dollar of income. So it would be the last tax bracket that you touch. The average tax rate would be the average of all the taxes you paid divided by your income. And it's an average of all the tax brackets that you're in. Now, you could have, both corporations and individuals could have what's called a capital gain or a capital loss. So a capital gain would be you buy a stock for $10, you sell a stock for $20, you made a $10 capital gain. Or maybe you buy a stock for $20 and you sell the stock for $45, you made a $25 capital gain. You have to pay tax on that. Now, what if you bought a stock at 25 and sold it at 10? You would have a $15 capital loss. So now, if you held an asset for a year or less, you would have what's called a short-term capital gain or loss, and those are going to be taxed at the ordinary tax rates. But in order to incentivize people to have longer-term investments, if you hold the investment for more than a year, you will receive a long-term capital gains. So, say for example, you buy 100 shares of a stock and you sell them, and you make $1,000 capital gain. So, if that capital gain, if it's a short-term capital gain, you could be paying 28% tax on that. However, if it's a long-term capital gain, you may only pay 15% tax on that, or 20%, depending on your income level. So the long-term capital gains, that's why it's incentivized to hold assets longer, so you can get a lower tax rate. Now, the short-term capital gain just gets taxed at the ordinary income, whatever gets put on top of your regular income. So it's usually taxed at the highest tax bracket you're in. So for most taxpayers, the long-term capital gains are only 15%. So if you were in, let's say, a 35% tax bracket and you had a long-term capital gain, you would only have to pay 15% tax on that. However, the tax rate on long-term capital gains is 20% for taxpayers who are generally in the highest tax bracket, the 39% tax bracket in 2017. So they're going to, and in addition, high-income taxpayers may incur an additional 3.8% unearned income. So tax. So this is an additional tax if you're high income, and this is in 2017. Not sure if it exists in 2018. So there's a lot of additional taxes. So now let's move over to the corporate side for a second. What is a tax carry loss, loss carry back, and carry forward? So this is another special tax situation. So if you're a company and you lose money on a business, it would be a corporate loss. And with that corporate loss, you could do something unique to corporations, which is called a carryback. So in a carryback, you can carry back up to 2 preceding tax years. But so if you had a loss in 2020 or say 2018, you could carry that back and redo your taxes for 2017, 2016. And then you could also, if the loss is big enough, you could carry it forward 20 years. So you can move that, if it's 2018 to 2038, and until that loss is consumed, you can move that tax carry forward up to 20 years, moving it forward. So that's something that a business can do. Individuals can't do that. Now, so the capital gains we talked about, and generally it depends on the timing, short-term or long-term. Now, I don't think that is changing in 2018, but it's possible. Some other tax situations that we should talk about: if you're an individual, you have the ability to save money in a traditional IRA or a Roth IRA. So a traditional IRA would be there's a limited amount of money that you could save in a traditional IRA, and then you put it in and you get a tax deduction. So if you put $5,000 into a traditional IRA, you could lower your tax payable bill by $5,000, or your taxable income by $5,000. Now a Roth IRA is different. You put in after-tax money. So here's the benefits. If you have a traditional IRA, you save taxes now, but will have to pay tax when you withdraw money from that IRA later. In a Roth IRA, you pay the taxes now, but then when you withdraw the money out of the IRA upon retirement, it's tax-free. So there's two different situations. And I guess it depends. If you're younger, it would make more sense to do a Roth IRA, since you're paying less tax and you have a longer time for that money to grow. And if you're older, in a higher tax bracket, and you're going to retire in, say, 10 years, maybe the traditional IRA would be smarter. Regardless, once you're age 59 and a half, you can start withdrawing from these IRAs. And that could be a nice gap, a bridge. So if you want to retire at, say, 60, you could use that IRA income to get you to the retirement age of 65, where you usually can start collecting Social Security and pensions. Although depending on your age, some people may have to wait to 67 or 68. Now there's another taxing situation that you should be aware of called the ATM. This is not the automatic money teller, but this is the alternate minimum tax. So this was created in 1969, about 50 years ago, when Congress learned that a number of millionaires with high incomes paid little or no taxes because they had so many tax shelters, tax deductions such as real estate, depreciation, municipal bond interest, that a law was proposed that under the law, these people would have to pay a minimum tax, and that the deductions would be capped at a certain level. The problem was with this law, they forgot to index it to inflation. So after 50 years of inflation, many middle-class Americans started to be caught into this new ATM tax. This has also been overhauled and updated for 2018. That might be something worth looking into, how they changed the tolerances for the ATM. It's still there for individuals, but they made it so that less middle-class individuals would have to pay alternate minimum income tax. Now, okay, there's also some special tax considerations if you're a small business. So if, say, you're a small business, you're not a big corporation, you're a partnership, a small business, then you would, basically what happens to these companies, you would have to pay tax as individual income, not as a business income. So small businesses and regular corporations, small businesses like partnerships and sole proprietorships are going to pay taxes as part of their individual income. Corporations are the ones that pay the corporate tax. One exception is called an S Corp. So an S Corp is a special type of corporation for small businesses where they don't have to pay corporate rates, but they can pass through the revenue into the individual rates and thus avoid double taxation. Although now it seems like if you were an S Corp, you probably would be better off as a regular C Corp, where you would just pay a flat tax of 21%. It's still most likely going to be lower than if you paid individual taxes. And another tax consideration to think about is depreciation. So depreciation plays a very important role for corporations. Think of depreciation like this. You buy a new car, you drive it for 6 months, and then you try and sell it, and you realize the car is worth $4,000 less than what you purchased it at. What happened? It depreciated because you drove it, it's no longer brand new. So corporations have assets that depreciate, like trucks and buildings and equipment, and that depreciation you can take off your income to reduce your taxes. It's one of the reasons that you learn in this course that when we analyze companies, we like to look at cash flow because it's more accurate generation of income than net income, because depreciation distorts the actual returns a company makes. So that's something to really think about as well. So you can see that this is just a high-level review of taxes. You can see how complicated taxes can get. So it's worth it to look into it a little bit deeper. And if you are a finance major or in college, you should be able to comprehend the tax code and even be able to use a software package such as TurboTax to do your own taxes. It really isn't too difficult, and with a little studying on the current tax law, it's quite easy to prepare your own taxes. Even if you have a complicated tax situation, the new software makes it pretty easy to run through and do your own taxes. And so I highly recommend people look into that. I'm not saying you should or have to do that. You may feel more comfortable with a tax professional, but it's certainly something you shouldn't be afraid of. Taxes, especially now with the tax code being a little simpler, that to try and prepare your own taxes, or at least prepare them before you take it to a tax preparer to see if you are doing a better job at it than they might be. Okay, so that's it for part 2 of chapter 3. Next time we'll be moving into chapter 4, financial statement analysis. Thank you and take care.